Brick and Banter Podcast. Ethan Burke, Irongate Realtors. Today I have
Lindsey Babakers.
There we go.
I'm with Cross Country Mortgage.
And you were actually the person who helped me get my first investment property.
I was. Yep. And we got it done, right?
Right. I was really excited about that because I'd gone to like 4 different lenders trying to get something going at different points in time, and all of them couldn't help me. I run into you one day, and the rest is history.
Yeah, we did help Ethan purchase his first investment property. The cool part was the type of loan that we were able to do for Ethan. It was a DSCR loan, and for those of you that don't know what that stands for, it's a debt service coverage ratio loan. And it's where all we have to do is make sure that the rent on the property covers basically the mortgage payment. And of course, you've got to have good credit and, a down payment, typically 20% down. But it's a great loan program for those that don't have the traditional types of income documents, tax returns, or W-2s or pay stubs that we would normally want to collect when helping somebody get pre-approved to purchase a house.
Yep. It's perfect for people who end up writing off a lot of their income. So
yeah,
people with a bunch of tax deductions, or people who maybe they get a lot in tips that they don't report, something like that.
Right.
Perfect for that.
Or it could be for, somebody who, is on a fixed income, of sorts, Social Security, or, a pension, and maybe their income just doesn't support basically to qualify to purchase an investment property. But a loan like this would definitely be handy and come into play and help them be able to qualify.
That's really cool.
Yep.
I appreciate you guys helping me out with it and getting it done.
Yes.
Like I said, nobody else can make it happen.
Good.
So you have a few investment properties too.
I do. My husband and I actually purchased our first property when we were 18 years old. And at that time, my grandfather was a real estate agent, and he had been a real estate agent for 35 years. And he encouraged me. He said, Lindsey, he's like, you and Dana should, purchase a property. And instead of buying a single family home, you should purchase a duplex, a 2-unit, and let the other side basically help make that mortgage payment. And I was like, okay, we'll look around. So he showed us some places, and we found a place. We purchased our first property at the age of, I think it was 18 or 19. I can't remember now because it's been such a long time ago. And we did move into that as our first home and rented the other side. And then we lived there for 12 months and then purchased our next home and then turned the property that we were vacating or leaving into a rental. The cool part about that is because we had lived there for 12 months, we were able to then utilize the rental income from the other side and the departing rental income from the side that we lived in to help us qualify for the new home. So we didn't really have to qualify with that payment at all because the rental income helped take care of that was coming in on that property. So that's how we started. And then we moved into a single family home and had a family, started our family. And then at that point in time, we decided to go ahead and just continue purchasing rental property and have been able to accumulate a decent, portfolio amount over the years. We've always bought duplexes, and we still have most of those. Bought a few properties over the years to flip, and then have kind of ventured down to Florida, that area as well. But I would just say, wow, if you don't have to be young to purchase an investment property, let alone a 2-unit, but if you are young, just do it. If you can qualify and, move into one side, even for like such a short period of time, 12 months is nothing. Move into it for 12 months. And then, in 12 months, turn that side into a rental and then go on to your next adventure, your next investment. Man, looking back on it, I think that we did a good job, right? You know what I mean? Purchasing these and starting really young. But, I kind of wish we would have done a few more. Now, I shouldn't probably say that because if my husband watches this, he's going to say, I wanted to do more. You know what I mean? Let's do more. Well, I'm at a point in my life now where I don't know if I want to do more now, but if I was younger, definitely.
Back in the day. Yeah.
Back in the day. Yes, back in the day.
I get that. Because, as soon as you get it, then it starts accumulating
I don't know.
appreciation.
Oh, yeah.
It starts appreciating over time. You get the passive income from the property.
Sure.
It's all good stuff from there. And then tax breaks for each individual property. So.
Yeah, we got super blessed. We were super blessed and lucky. When we invested in Florida, we basically had purchased a place right during COVID. And then kind of the market shifted, and where we had purchased the home, there was massive appreciation. Like we're talking maybe not double, but close to it. So, I mean, it was just perfect timing, right? So definitely, timing is crucial when it comes to this kind of stuff. But I mean, the key is just do it, right? Yeah. Don't be scared. Yes, it's not all fun and games, right? Owning investment properties. I mean, sometimes there's things that pop up and repairs that need to be made and situations that occur with potential like not so great tenants that you have to address and evict. And honestly, over the years, I don't think we've had that many that we've had to evict, but it's still worth it in the end because this is your retirement, right? This is for your family, your legacy, what you're leaving, for your family and what it's going to help you get through once you're ready to step back from your work in your job or your career.
Right.
So
what kind of loans did you get on your first couple properties?
The first one, we did an FHA loan.
Okay.
And the reason why is because it was going to be owner-occupied, an owner-occupied property. FHA will allow you to purchase a property owner-occupied, a duplex, a 2-unit with just a minimal 3.5% down. So you don't need very much down payment at all. And that is still true today. If you're an individual, looking to purchase a home, a duplex, and you're going to live in half of it, all you need is 3.5% down to go FHA. And that's how we purchased our first one, was FHA, because it was owner occupied. Now, the rest of the ones that we purchased along the years, they weren't owner occupied. So we put a decent amount down on those. We're probably 20% down every time.
So those all like conventional loans? Conventional.
Yeah. I've never done a debt service coverage ratio loan yet. So, but I'm not saying it's out, I'm not saying it's not that won't happen, but I'm still not sold yet on purchasing anything yet.
No, you're good. Yeah, I definitely understand it. If you can do a conventional, it seems like it's probably easier and less paperwork, I would imagine.
It's really not so much the paperwork part. It's just like, with an FHA loan, the condition of the property does have to be no safety or habitability issues. So like if you have a property that has peeling paint, sometimes that can come back flagged by an appraiser that has to be fixed, prior to closing. But yeah, most of the other ones were just conventional financing. But the first one definitely was FHA, 3.5% down. And back then, I'm dating myself, you could, believe it or not, get the seller to pay your down payment and do a special program. It was called, Nehemiah, I think was the name of the program back then. And that's where the seller could pay your down payment for you. It was very short-lived, okay? But that program, however, is no longer available, right? But back then, that was a normal thing. I mean, that was almost 30 years ago. So a while ago.
So here is a question. One of the things I want to get into next is some kind of flip. Are there any kind of loan programs that work well for flips? Or is it? There are specific loan programs that you would have to ask about when asking about a property to flip. They're called fix and flips. That's basically what they're called. That's the name of the loan?
Yeah, it's a fix and flip. And basically it will allow you to, finance the repairs into the loan, to do what you need to do and then turn around and flip it, within a certain period of time.
So what are the stipulations with that? Like the repair costs estimates, those have to come from Like contractors?
It does.
I assume.
Yeah.
Make it up.
It's not, they don't allow, at least the program that we have available, and I'm not really aware of any other ones that have the availability of you doing your own work. And the same thing with like other types of loan programs, like your renovation loans that you have and stuff like that. Most of those have to be done by a contractor that's licensed and insured to make sure that if, accidents do happen and, if there is an accident, you know what I mean, that the contractor's insured to be able to cover whatever the accident is that happened. We had a situation on one of our homes that we were having some repair work done to, and there was a leak, and, you got to make sure the contractors are insured for sure.
So you couldn't go out and get like a handyman to come in and give you estimates. It's got to be like a licensed plumber or a licensed roofer?
I'd probably have to check on that.
Okay.
For sure. I don't think it so much has to be licensed, so to speak, because like I think in Ohio, and I could be wrong about this, but I think in Ohio, general contractors I don't think have to be licensed.
Yeah. I think most of them aren't.
Yeah. So I don't think they have to be licensed, but I do think that they have to be like legit.
Yeah.
You know what I mean? A business and insured for sure to make sure that, we're covering all of our bases, and if there is issues that they're going to be covered and you're protected too. That's the thing.
Okay,
so.
Perfect. Yeah, because when I got my duplex, I had a guy come out from Charlie's Custom Painting. They did a great job.
Yeah.
He started out with painting, but then he moved on to doing literally everything. He helped me reinforce like foundation beams, built on closets. He can do everything.
Okay.
So that was mainly my question for that, because I'm assuming I would have him do most of the work.
Most of the work. Is he insured?
I'm sure he's insured.
Okay.
Yeah, he's got a legitimate business. I just don't know if he's like a licensed plumber or roofer or anything like that.
Got it. Yeah.
So I didn't know if that would come up or not.
Sure.
What is the down payment on something like that?
On the fix and flips, 15 to 20%.
Okay, that's
down.
not terrible.
Yeah, it's not terrible. No. And I mean, mostly on your investment property, if you're purchasing a home like as an investment property, you are going to be looking at needing about 20% down if you're going conventional. DSCR. I mean, occasionally I will tell you that like Fannie or, they will allow for 15% down on a conventional loan if you have like super high credit scores. But when you go above 80% loan to value, then you have to start paying PMI, right? That private mortgage insurance. And then also, the interest rate's affected. The interest rate's higher if you go above the 80%, on an investment property. There's more adjustments. So sometimes it's just worth putting the 20% down so that you're not having to, pay those extra fees associated with putting just the 15% down.
Yeah, I think that makes sense.
Yeah.
Now, what about like minimums? Like, I had one guy ask me about like a $40,000 house. So I don't know is there a minimum or a maximum? Yeah, a minimum that you guys will actually do?
I think every lender has their own minimum that their particular company will allow for. At Cross Country Mortgage, we actually go down to about $40,000 actually. Okay. At previous companies that I've been to in the past, it has been higher than that. It's been anywhere from 50 to 75. So I think specific companies will give the minimum on what their minimum is for loan amount.
Is that like the total value of the property, or like the loan amount has to be at least that much?
The loan amount.
Okay.
Yeah. So like if you're purchasing $100,000, 20% down, you'd be borrowing $80,000. Yeah. I will tell you on those debt service coverage ratio loans, there is a minimum loan amount, and it's $100,000.
Okay.
Those non-QM loans, which stands for non-qualified mortgage, there is a $100,000 minimum loan amount on those. You can ask for an exception for a loan amount less than that, but it's one of those things that the exception has to be approved. It's not guaranteed.
Yeah.
So to write a pre-approval letter for somebody that is looking for a property under $100,000, on it needing a DSCR loan, we definitely have to make sure we do our due diligence to make sure they will approve that exception, and they'll go that low.
Yeah. Makes sense. So other than FHA loan, I know there's like low down payment conventionals and stuff. What would be good for like a first time home buyer?
Well, we can do, if you're a first-time home buyer, you can definitely go conventional and do 3% down. We have some great programs for individuals that make under a certain amount of income. It helps with the interest rate, keeping the interest rate super low for first-time home buyers. So 3% down would be needed on a conventional loan if you're a first-time buyer. At Cross Country Mortgage, we actually have a program called our Smart Start loan. And that's where we will give first-time home buyers that meet that income threshold. And it's dependent on like the county that you live in. We will give them 2% of the 3% needed for the down payment. So basically, they could purchase the property with little as 1% down after they get the 2% from us. Of course, you would then need to negotiate and ask the seller to pay for closing costs. One thing I would strongly encourage and recommend, and that's why you always want to make sure you're working with a qualified, knowledgeable lender, is don't ask for too much closing costs on a conventional loan, because on a conventional loan, they will max the seller paid closing costs based on the amount you're putting down. So if you have a buyer who is putting 3% down, the most the seller can pay is 3% in closing costs. So if you're purchasing a home, $100,000, the most the seller can pay in closing costs would be $3,000. So the buyer might be responsible for some additional closing costs that the seller can't pay for. So the Smart Start loan, if you are a first-time home buyer, is awesome because we'll give you 2% to go towards 3% needed. You just have to make sure you qualify income-wise, and you do have to be a first-time home buyer on that program.
That's pretty cool. And is that one where that 2% gets like forgiven over time? Or is it just there? And
yes. It's not a second mortgage. It's not anything that has to be paid back. So there's no recapture on it. It's just money that's coming from us that we're going to give you to go towards your down payment.
Cool.
Yeah.
And that's is that dependent on how long they live there? If they move in, they use that loan, and then something happens, somebody loses their job, they immediately have to sell it. Do they have to pay that back? Or
they do not. No,
cool.
They do not have to pay that back. No. I mean, that's why I'm saying it's a no-brainer.
That's awesome.
We do a lot of them. And we just, the qualifications are just we have to make sure that it meets the 80% HUD income limit, dependent on the county. And I mean, I don't have it. I'm trying to think what that is in Montgomery and Greene. I think it's around 73-ish thousand. So if the individual that's on the loan makes under 74, 73,000, they're going to qualify for that program. Yeah. Just be a first-time home buyer and call us.
Yeah, being a first-time home buyer, there's a lot of fun programs you can utilize.
Yeah, there are great programs. And this one specifically, though, because you don't have to pay it back. Some of the other programs that are out there, you have to live there for a period of time, like through the state of Ohio, the OFA program. It is a great program, the Ohio Housing Finance Agency, but there is a recapture period where you have to live in the home for 7 years.
I've heard that, and so much of the amount gets forgiven each one of those years, and then once you get up to actually 7, it completely goes away.
Yeah, well, from my understanding, that is how it used to be.
Okay, they changed it.
From my understanding, now it's a 7-year recapture, which means if you sell it within the first 7 years, you're paying it all back.
Oh, okay.
Yes, and typically, I'm not saying all the time, sometimes you can get a better interest rate on the conventional Smart Start loan that we have versus if you were going with one of the state agencies too. So better rate, and you don't have to pay it back. I always look at that one first, but not everybody can go conventional, right?
Yeah.
I mean, if you have somebody that needs to go FHA, whether it be because of maybe income to debt ratio is a little bit higher than what conventional wants us to go, or maybe there's some potential credit issues and we have to go FHA, then sometimes we have to look at, some different options for down payment assistance.
Gotcha. That was something I was going to ask about, is if there was a credit limit or what the difference was between like FHA credit limit and conventional credit limit, things like that. There's got to be reasons why people pick FHA over conventional if there's just that many better reasons to go conventional.
Yeah. Gosh, it's hard to say because every Every loan is so different, right? Normally, if you have somebody that has a credit score, and I got to be careful what I say here, so you might have to edit this out. Of 660 or less, sometimes FHA ends up being a better option, just because on a conventional loan, a lot of times the way the interest rate that you're going to be receiving, there's different loan level price adjustments that go against and hit the interest rate depending on what your credit score is. So on a conventional loan, the higher your credit score is, the better the rate you're going to get. Okay. So like sometimes when on a conventional loan, when you start getting under 680, 660, it gets kind of, the rate kind of gets dinged and kind of gets hit a little bit because your credit score, is lower. So sometimes it ends up being cheaper to go FHA, because there's not the same loan level price adjustments on an FHA loan than there is on a conventional loan. Plus mortgage insurance, PMI, if you have credit scores that are lower, the PMI gets super expensive too on a conventional loan. Whereas on an FHA loan, the PMI or the mortgage insurance that you pay is going to be the same, whether you have an 800 score or a 600 score. So sometimes it just makes sense. I ran a scenario not too long ago comparing. I had somebody, I think they had a 667 score or 664 score.
Right on that threshold.
Yeah, right on that threshold. And I ran a payment conventional, and then I ran a payment FHA, and their interest rate was better FHA. The mortgage insurance was better, obviously FHA, and I think the payment was like $140 or $60 lower if I could get them into a home FHA versus conventional. To me, that's a no-brainer.
Yeah.
I mean, as long as
the house qualifies.
It qualifies, right, for FHA, and as long as, it'll pass an FHA inspection and there's not other multiple offers on the home that are conventional, because sometimes if there's multiple offers, sellers tend to lean at taking a conventional offer, right, over an FHA offer just because of the inspection or the appraisal piece.
Yeah, that's a good thing to know. There are hierarchies to these loans. So if you're selling your house and you get an FHA offer, a conventional offer, or a cash offer, there's reasons why people pick that cash offer first.
Sure. Yeah.
Even if it's all for the same amount.
Right. No appraisal needed. It usually closes quicker, usually within 2 weeks sometimes, on a cash offer. So, yeah, I mean, VA, though, I will tell you, we do a lot of VA mortgages, and our veterans, we went through a short period of time here where I felt like a lot of sellers were just automatically like throwing VA offers to the side and wanting to take FHA offers or conventional offers in front of VA. Don't do that. I mean, we need to be out there supporting our veterans. And we have, with Wright Pat Air Force Base being here, we have so many people that are PCSing, every year into Wright Pat Air Force Base. So if you get an offer to go VA, I mean, be that advocate, you know what I mean? I feel really strong about that. Be that advocate, especially, if you're an agent, and say we have this offer, but, we have this veteran here who's wanting to use his VA home loan benefits who serves our country. I just feel like give them a shot, right? It's a great loan program for them. On a VA loan, VA guarantees the loan, so they don't require the veteran to put any money down, and there's no PMI. I mean, the no PMI thing is huge. I mean, on a $500,000 home, imagine paying mortgage insurance on that every single month. That's huge for the veteran. It gives them a break, right? It helps them keep that payment down. So we definitely love our veterans here at Wright Pat Air Force Base. So definitely try to accept those VA offers if you can.
Yeah, I love Wright Pat. Both my parents retired from working jobs over there. My brother and his wife both work up there. It's a great spot.
We're so lucky to have Wright Pat here. Honestly, it brings so much to this area. Jobs, real estate. Think about that. How many people are buying homes that are active duty, right now, and even not active duty, you know what I mean? All the civilian workers that report every single day to Wright Pat Air Force Base. So, I don't know how we got on this topic, but I think VA, accept those VA offers, please. I just hear that a lot. They went with a different offer because ours is VA. I'm like, why? Honestly, I would tell you that out of all the loan programs that I do, I love doing VA the most. They're super streamlined. There's no extra work involved in them. And I never really, most of the buyers that are coming in that are going VA are super qualified. And I don't think people realize that. They pay their bills, you know what I mean? Their credit's good, So, sometimes these VA offers or these VA buyers that we have are probably more qualified than even sometimes our conventional and our FHA. So let's get some VA contracts accepted.
Yeah, the VAs they're very good programs. They're usually great people to work with. I've worked with a few of them.
Yeah.
And I don't know why people wouldn't accept them over other offers. That
I don't know. There was a time period here over the last few years that's, like after COVID, I felt like, I said that word, sorry. After COVID, that's just, they were like, when everybody was in multiple offer situations, you know, when there was like 5 offers on every single house.
Yeah.
It was like automatically, I felt like that was like, people were like, don't go that way, take this offer.
That's strange. I understand picking cash because cash is the easiest, hands down. There's less red tape.
I would
they
agree.
Don't have to get approval from anybody. Like you said, they don't need an appraisal or anything.
Yeah.
They don't even need to do an inspection. If they don't want to, they can just pay the money and buy the house.
Yeah.
But all the other ones, I don't understand why they do that.
I'm just telling you, I look at a lot of different people, on a weekly basis, and the people who apply for a VA mortgage are sometimes more qualified than what a conventional buyer would be. Other than the down payment piece, And then sometimes veterans on a VA loan decide they want to put money down. They don't have to do 100% financing. But sometimes we have some people utilizing and doing VA mortgages that say, I want to put 5 or 10% down. So it doesn't automatically mean they're doing 100% financing. It just gives them the ability to finance everything if the veteran would want to do so. But the no PMI thing, there's not a better loan program out there for a veteran or for if you could qualify for a VA loan than to definitely go VA.
Very cool. So
good rates too.
Let's say, is the VA loan one that you have to occupy?
Yes.
Okay.
Yes, you do have to own or occupy it. However, I will tell you that if you, let's say, get orders to then leave, Wright Pat Air Force Base, and then you're transferred to another base, VA does allow you to do what's called a interest rate reduction loan, an IRL, on an investment property to take advantage of rates going down. So like if you have somebody who, let's say, purchased a home a year and a half ago here at Wright Pat, and let's say that's when rates were higher, right? Let's say that the rates were, 7.5 at that time. And let's say that they got, orders to go to a different base. And then let's say they picked up the phone and they say, hey, rates are lower now. I want to refinance. They could still do what's called a VA interest rate reduction loan. And even though they're not owner occupying it anymore, VA will allow them to take advantage of the lower rates.
That's cool.
Yeah. And so they don't still have to be living in the property to do that either. So I think that's cool that VA allows them to do that because they can't help. They got orders, to another base.
Yeah.
So why should they have to, get stuck at that higher rate? So we've done a few of those here recently with the market moving, where people are refinancing, properties here in Beaver Creek area or in the Miami Valley, and they no longer live in them, and doing VA interest rate reduction loans, even though they're not here anymore.
Very cool.
Yeah.
So I hear the term refinance a lot. Does that cost as much as pretty much redoing the whole thing? Do they need another appraisal, or is it pretty situational?
Case by case. And I say this because, if somebody had, let's say, purchased a home with me a year and a half ago, we have a program that's called Buy Now, Refinance Later. So, anybody who purchased a property with me in the past year and a half to 3 years, they can come back and see me and refinance, and there not be any kind of lender fees. So they're not charged an underwriting fee or a processing fee or anything like that. Appraisal, it depends on their overall situation. If they have good equity position and they have good credit, sometimes when we run everything through our system, we get an appraisal waiver, which means we don't have to do an appraisal, but that is a case-by-case basis. And we don't know that usually until they tell us they want to refinance. We run it through our automated underwriting system. It reads basically the address of the property. It pulls other comparables in that have sold basically in that immediate neighborhood and kind of like throws out a risk threshold on whether or not they feel like we could waive the appraisal or not. So like I'm doing a refinance right now for an individual who we had done a 30-year mortgage for. We were able to refinance them down to a 20-year mortgage, keep the payment the same.
Nice.
And there was no appraisal needed. And in this situation, because I had helped them purchase the home a few years ago, we didn't have to pay any or charge any kind of lender closing costs. Now you do have title closing costs, for the title search to be done, the recording fees and stuff like that. But there was no lender closing costs on that one.
So if you have somebody come in with, like, let's say their credit is too bad, they got something on the report that pops up they didn't know about. How long does it usually take for them to fix that, or any kind of advice for people like that?
I would tell you that it's worth your time to speak to maybe a professional credit counselor. I guess it depends on like how in depth, you know what I mean, the repair is. Sometimes I can look at a credit report and just give them some tips and tricks to how to get your score up, right? If somebody calls me and let's say they're at like a 640 credit score and they're really wanting to go conventional for whatever reason, and so they're wanting to try to get their credit score up to get a better interest rate, sometimes I can look at a report and say, hey, if you pay off, your revolving credit card, or you pay down your revolving credit cards to where you don't owe 30% or more of what the limit is on the cards, your scores will get boosted. Sometimes I can give them like some little things like that. But if it's somebody who has had, went through life and just has had some challenges, you know what I mean? Like whether it be collections, charge-offs, repossessions, maybe a past bankruptcy, and their score has just never been able to rebound, I would encourage you to reach out to like a credit counseling service. And I do have a few names of individuals that I have referred to in the past where they will actually go in and go through your credit report and tell you exactly item by line everything that you can do to try to get your credit score increased. Some of them do have, I think, like a small fee or charge to help you do that. I'm not affiliated with them at all, but you would have to do your own due diligence and just shop it around to see who you felt the most comfortable with. But I would probably recommend somebody to reach out to somebody who specializes, in credit repair, especially depending on, how intense the credit repair is.
Now, this is something I've heard, and I want to double check to see if it's true or not.
Okay.
So I've heard that obviously when you do a hard pull on somebody's credit for buying a house, it dings their credit a little bit.
Yeah, okay.
I've heard that they have 30 days from that first ding where they can get their credit checked by any number of lenders for that same reason, and it's not going to ding their credit again. Is that true?
Yeah, that is true. However, I will tell you that we don't normally, where I'm at Cross Country, do hard credit pulls initially. We will start off with a soft credit pull, so it doesn't ding their credit. And I've tried this. Our soft credit pulls seem to be almost identical to the same credit score as it is when you do the hard credit pull, because like there has been situations where I've done a soft credit pull, they've got under contract, and then at that point in time, once they're under contract, I'll do the hard credit pull. So then I do the hard credit pull, and then the scores are pretty much the exact same. Okay. We do that a lot of times, just do the soft pull so it's not showing up as a hard inquiry. This is a hot topic, but thankfully it's getting ready, hopefully, to go away. But a lot of times lenders will not do hard credit pulls initially because, have you ever heard of trigger leads?
No.
Did it not happen to you when I pulled your credit? You didn't? Are you on the do not call list by chance?
I don't remember. I don't think so.
Okay. So as an industry, it was just passed that these hopefully are going away. But I'm sure some people that are probably watching this will tell you how frustrating it is that they have somebody do a hard credit pull or inquiry on their credit, and they start getting blown up from lenders soliciting and telemarketing them. I had somebody not too long ago tell me that I pulled their credit because I had to do a hard credit pull once they were in contract to purchase the home. They told me they received 50 phone calls and text messages from other lenders trying to solicit them to get them to use them for their mortgage services once I did the hard credit pull. Now, keep in mind, I'm not selling their information, right? It's the credit bureau. And the credit bureau is not selling their personal information, such as like their phone numbers and giving them that kind of information. But they're basically selling so-and-so, in Dayton, Ohio is, looking to get a mortgage. There's companies, these companies have like people's whole jobs are to find out these people's contact information. So they're scouring the internet and trying to find out, Googling people, and I'm sure they have services to find out what what their phone numbers are. And if you're not on the do not call list, then basically you're going to start getting crazy amount of phone calls, to solicit you to say, why don't you use me for your mortgage loan? Instead of Cross Country Mortgage or instead of ABC Bank. So thankfully it was passed that trigger leads are going away. And nice. From what I understand, hopefully springtime, they will no longer be able to do that. The only people that will be able to call you if your credit was like done with a hard pull, from what I'm understanding, is if you have like a current relationship or a mortgage with your current mortgage company, then I do think they would have the ability to reach out to you. But all these random companies that are, reaching out and they borderline harass people. I'm talking like call, text, call, until somebody picks up the phone. And honestly, some of them aren't super, forthcoming and kind of like make it sound like when they call, well, hey, I see where you, applied here at Cross Country Mortgage. Well, they didn't, making it sound like they're working with me when they're not.
Yeah.
So it's just, I don't know how I jumped on this tangent, but it's just a huge thing that every mortgage lender will tell you they hate them because it just, people are like, why are you selling our information? We are not selling your information. It is 100%. The credit bureau is just stating this person's looking and, then they're going out and searching and trying to find you online. So do you ever get phone calls or text messages from, we want to buy your house, those people?
Randomly, yeah.
How do they get in your number? They're doing the same thing. You know what I mean? They're scouring and trying to find you online. They're finding out you own that property. And then they're finding you online and saying, I'm so-and-so and I'm looking to buy your home. I get those too a lot.
I get those from me. I also get them from my parents. So.
Oh, you do?
I'll get a text that says, hey, I'm looking to buy your house. Like, well, my dad owns that house. So
yeah.
It's not mine.
Yeah. So it's just, I'm sure there's some like kind of service that they subscribe to that helps them try to find phone numbers. But anyway, soft pull, that's how we were talking about it. Yeah. Soft credit pull. So we do a soft credit pull because if we do a soft credit pull, it doesn't generate that craziness, to the client.
Perfect.
Yeah.
Yeah. I had that same kind of thing when I was looking for health insurance. I had made the mistake of putting my information in one site. I immediately got 5 back-to-back phone calls.
Sure. Yep.
Ridiculous.
It's nuts.
Yeah. It'd be nice if they put a stop to the trigger leads. Do you know if the thing they were talking about for the credit affects that too, or is it just straight up credit?
I think that's just for mortgage.
I didn't know if that term trigger leads was like.
Oh, yeah, no. I think it's just for the mortgage piece of it. I could be wrong. Don't quote me on that, but I think it's just for mortgage. We have some really cool construction loan programs at Cross Country Mortgage.
Is that for like new construction?
New construction.
Oh,
yeah, we have some great new construction loan programs. And we have some programs that like a lot of banks and other companies don't offer. Like we do the VA construction loan at Cross Country. And I mean, you'll know too, if you've ever, looked at a VA construction loan, not very many people offer it at all. It is truly 100% financing up to $1 million on a construction loan. So we offer the VA construction loan. We offer FHA construction loans. So you don't have to be a conventional buyer to build a house. You could go FHA. We also offer conventional, 5% down construction loans. I guess the reason why I'm bringing this up is because I had a phone call yesterday about somebody wanting to build a new home. They were interested in lumping in the land purchase with the build, and we can do that. It would just be a total cost to build. So we take basically the cost of the land plus the cost to build, lump those together, and then at closing, we would, of course, disperse a check for the land, to pay that off. And then we would give the builder, I think it's up to 10% to get the building process started on the initial draw. So we have some really cool construction loan programs. So anybody looking to build. We do a lot of the other non-QM loans, like we were talking about DSCR loans. We also have bank statement loans. So if they're not looking to purchase like an investment property, if it's somebody looking to purchase an owner-occupied property, and let's say they don't want to qualify or they can't qualify with traditional means tax returns, bank statements might be an option. So instead of looking at their tax returns, we would look at 12 to 24 months worth of their bank statements and, look at the deposits and then average those out to figure out what we can use for income. That can make a huge difference in what somebody can qualify for because, as you know, if you're self-employed, right? Most self-employed individuals try to take advantage or try to write off, it seems, a good amount of expenses to try to keep their income lower so there's less tax have to be paid, right? So depending on how much somebody writes off on their taxes, it could cause them to potentially not qualify for as much as they were hoping for. So if you're in that situation and let's say that you might write off too much on your taxes, a bank statement loan might be a good option for them because we're going to look at their bank deposits for the business and average those out to figure out what we can use for income.
You said you look for, was it 1 year or 2 years?
You can do 12 months. I mean, I do think there's actually a 6 month too, but the more bank statements you give, the better the terms of the loan are because it's a better overall picture of what you're really truly making. So we could do a 12-month bank statement loan, or you could provide 24 months and you might get better terms, better interest rates. You know what I mean? If we provide more bank statements to show that you've, been self-employed longer.
Nice.
That's a great program. It does require pretty good credit though. And of course you do need, I hate to say this. I say 20% down. I do think you can actually do less than that down on the bank statement loan. But if you put less than 20% down, it really changes the rate. So usually on those non-QM loans, you probably need to try to, in your mind, think typically 20% down.
Makes sense.
Sometimes you can do less, but then you might not want the terms that come along with that.
Yeah. People who have a house and they're looking to buy a new one. I know there's bridge loans, blanket loans. I don't know the difference between the two. Any other options? An in-depth view on those too.
Why would you do a bridge loan? Okay, so what a bridge loan would allow an individual to do is access basically the equity in their current home to put down on the new home without having to sell it first. Okay. So you'll have a lot of times people will say, well, I really love this home, but I need to sell my home first because I need to get the equity out of my home to put down on the new home. So a bridge loan would be perfect, right, for that individual because the way our bridge loan works, and people's bridge loans might be different, but we will allow an individual to pull out up to 85% of their value on the home that they currently own. We don't do a normal appraisal. We'll do a BPO. We'll order a BPO, a broker price opinion on those. And then whatever it comes back at, we're going to allow them to pull out 85% of that value. So depending on what it appraises for versus if they have a loan would determine, how much we're able to give them. But that would allow them to utilize and pull out that equity in their current home to go ahead and purchase the new house and put down on the new house. So bridge loan is a great option. Another thing sometimes people will do in this situation, let's say that they don't need the equity, but they're still worried about wanting to put that extra money down once their home sells. But let's say they have enough money in their checking or savings account to put down on the new home. They could go ahead and purchase the new home, okay, without selling theirs first, use the money they have in their checking or savings account. And then once they sell their home, they can do what's called a recast. It's not a refinance, it's a recast. And what a recast is that's where you reach out to your servicer, which would be Cross Country Mortgage. We do service a good amount of our loans. They would reach out to Cross Country Mortgage and let them know that they're wanting to recast and make a principal payment. There's an application that they have to fill out. They make the principal payment on the loan, and then the lender or servicer will recast that mortgage. I usually think there's a small fee associated with that. It's ours is, I think, $250. They pay a one-time fee of $250, and they will recast their payment based upon the amount that they're applying towards the principal for that small $250 fee. And then they don't have to pay to refinance. A lot of times people are like, well, I don't want to have to pay to refinance again. You know what I mean? And pay all those extra closing costs. So that is an option for some people to just do a recast after their home sells and recast their mortgage and pay that small $250 fee or whatever it is, depending on the servicer or who your loan is through. You cannot do that on government loans, though. So if they're going FHA or VA or USTA, they don't allow you to recast. You would have to refinance. On conventional financing does allow for you to recast. So if you're interested in recasting, make sure you're going conventional. Don't, be going FHA or VA and think you can recast. They will not allow for that.
So that small period of time where they technically own both properties, where they find the house they want, they move into it, and then they list their house. Are they paying two mortgages during that time? How does that work?
No. So they would be paying the mortgage on the new house, right? So that mortgage would basically start. However, on the bridge loan portion, the money that you took out, whatever the amount was that you cashed out, interest is accruing, right, on a daily or monthly basis or on a daily basis. But that interest is just going to keep accruing, and then it will be added to your payoff at the very end when you go to pay off the bridge loan. So you don't have to make any payments on the bridge loan. Now, I don't want you to think that it's free, because it's not. Interest is accruing on a daily basis, but they will add that interest on at the end. So when you request the payoff on the bridge, it'll be for the amount you borrowed plus the interest depending on how long it took you to sell that property. So that's helpful, I think, not having to make that extra payment on the monies that you're taking out to put down on the new house.
Yeah, just the interest only is a big thing. I don't think people realize. They think they're going to be paying two mortgages out for a month or two, and it's not quite that.
Yes, that is correct. I guess the only thing I would add to that, though, is if let's say they have a mortgage on their home that they're looking to sell, and then I do the bridge loan, they're not going to make payments on the bridge loan piece. When we do the bridge loan, we don't refinance the two of those together. So they would still have, I guess, technically the mortgage if they have a mortgage.
Okay. A
first mortgage. It just, they wouldn't make payments on the money I'm giving them to put down on the new house.
Okay.
Does that make sense?
A little bit, yeah. Yeah, that's a more complicated situation because you're trying to finagle two transactions in at the same time.
Yes. Yeah. Yes. But it serves a purpose. I probably have closed, 4 or 5 this year. I mean, I don't feel like it's as popular as it would have been 4 years ago when we were in the height of when it was kind of crazy, when rates were, 2.5%, 3%, multiple offers,
Yeah.
I think back on that time and it was nuts. I wish I would have had a bridge loan then because I think I counted that year and I probably missed out, unfortunately, on about 14. I wrote them down. Different buyers that I was unable to help when I did not have a bridge loan that year because everybody was in a multiple offer situation and nobody wanted to accept a contingent offer. So in order to get around a contingent offer, you had to, do a bridge loan.
That's an interesting scenario, trying to sell a house and use that money to buy another one, because there's a lot of different ways you can do it and lots of pros and cons to all of those different ways. Bridge loan, I think, is probably one of the easiest because you don't have to do some sort of multiple move scenario where you sell your house, move into an apartment or move in with family or something.
Right.
Then buy a new house, then move the money over.
Yeah, and even coordinating occupancy dates, on your end, that's crazy. You know what I mean? Just trying to make sure that, occupancy dates line up and stuff when you're trying to, if they're trying to sell their house and then get it under contract and then you're just making sure that somebody has a place to live, right?
Yeah. Yeah, that's always a fun one. For the people who don't know out there, occupancy date is you basically sell your house, but the people who bought it allow you to live in it for a little while, usually so you can move your stuff from the house you sold to the house that you bought.
Right.
And it's always a nightmare to set up because nothing's ever perfect. Things happen. Something will come up with somebody who's buying the house that these people are selling to buy this one, and then everything gets delayed, and now you have to make sure that the people whose house that you're buying are okay with the delay. It's a giant pain.
Yes.
And like you said, people don't like accepting contingencies. To really have something like that set up, there's so many contingencies involved that it's not likely people are going to pick it unless you're overpaying for that property.
Right.
It's just a giant pain.
Are you still seeing multiple offers right now? Are you seeing a lot of that, or is it calmed down a little bit?
It's calmed down a bit.
Okay.
Right now it's kind of in the middle. It's still, I would say, a seller's market right now, but it's getting more towards the center of that. It's not just as hardcore as it was before.
It was pretty hardcore there for a while.
Yeah. Yeah. You list a house and then you get 3 offers in the first day.
Yeah. It was fun, but at the same time, I don't know. I mean, we had some long days there for a while.
It's fun if you're a seller. It's a nightmare if you're trying to help.
If you were a buyer, 100%. Yeah. I mean, I normally will tell my buyers that, if they find a home that they love, to reach out to me before they make an offer, and I will work up a payment for them, right? I'll look at the taxes on the property. I'll, estimate based on current interest rates, see what they're looking at. So there's no shock. You know what I mean? On what the payment's going to be. I mean, during that time, I felt like I remember there was one person that I think I had counted. I had ran 20 some payments for. I mean, I can't even imagine being in your job, showing somebody that, you know what I mean? That is crazy. You know what I mean? Having to write that many offers. I don't know if they actually wrote that many offers. That would be nuts, but how many offers have you wrote for somebody the most?
There was one couple I probably wrote maybe 5 or 6 offers for them.
Okay.
But they were that scenario where they had to sell and buy. They wanted everything contingent upon everything, and there's just not a lot of people who are going to agree to that.
Yeah. I do feel like there's been more contingencies here lately, though, than I've seen in a while.
Lately, yeah.
That have been coming across my desk. I know every time I call somebody, and they can't, let's say, qualify, for a bridge loan or anything. And I'm like, it's contingent. I'm like, oh, sorry, but it is what it is, right? I mean, sometimes you can't qualify with both. So, I mean, they can buy a new home, but it might have to be contingent on them selling theirs first. And then there's some buyers that maybe they're not comfortable comfortable buying a new home unless they sell theirs first. They're like, absolutely not. You know what I mean? I'm not buying another home, you know what I mean, unless mine's sold first. So I guess everybody's just different.
What I run into the most is people who are like, oh, yeah, I want to buy this one. But I need the equity from this one. I don't care about that, though. I really just want to focus on this one I want to buy. You got to figure out how you're getting the money to buy that first.
Yeah, well, we could always look at the bridge loan to see if that would be something that would work for them. I think it's a great, just something to have in your tool belt. You know what I mean? It's not something you're going to do all the time, but I mean, like I said, I've done probably 4 or 5 this year, and it's served the purpose, for them and helped them.
Back on the investment property, for a second when the question just popped into my mind. So if I'm looking to get the next one and I have the first one, how do I go about using the first one as leverage to get the other one? Is there like cash out refinance options, or how does that work?
Cash out refinance options on an investment property get a little bit sticky just because they really limit your loan to value at it's pretty low. I think it's, without having it right in front of me, I don't think they'll let you pull out more than 75% of the value of the home. So if you just purchase the home, right, and you only put 20% down, there's probably not any equity that you would be able to pull out. But they will allow you to, depending on it, as long as you have, tax return. And this is a key thing. If you're purchasing investment property, make sure you are showing the rental income on your taxes. If you want to use the rental income, right, to help you qualify in the future, to help offset that payment, you need to make sure that you're using, and putting that on your tax return. The only reason why I say that is I had somebody last month, they had owned an investment property and they've owned it for 4 years, but they were renting to a friend and they just didn't feel the need. You know what I mean? Because they weren't making any money on it. The friend was just basically making the payment, right?
Yeah.
They didn't feel the need to file a schedule on it, on their taxes, and now they're coming and they're wanting to, purchase another property. Well, that rental income would have been super nice to have, you know what I mean, on the taxes to help offset that payment. Because if you're not showing the rental income on your tax return, we have to count that entire payment against you. Even if you are renting it, they're not going to let you use a lease if you've owned it for over, 12 months. The only time you can typically use a lease and use 75% of what it's leased for is if you, let's say, you just purchased the property this year, okay? And let's say, you purchased it in February. Now you're looking, to potentially, refinance or purchase a new home, then we could, potentially use 75% of the lease because you haven't had the ability to show tax return yet. So the key is, if you own a rental property, even if you're renting to family, that's another one. A lot of times people will buy a property for their family to live in. At least get it on your taxes so that we can see it on there, so that we can maybe use some of that income, to help offset something in the future. And
when you say get it on your taxes, you mean actually have
file a schedule. Yeah, okay. File your schedule. Is it Schedule E? Yeah, Schedule E. Put it on your Schedule E.
So they were getting under the table payments as opposed to getting it and then getting tax write-offs for it. They were just under the tabling it. Got it.
Yeah,
okay.
Because in their mind they said, I'm not making any money on it. And they weren't, They were the person that was living there, whether it be mom or dad or sister, brother, their kid. I'm buying this property for my kid to make the payments. My kid just makes the payments. I'd still get it on your Schedule E and just, get the income on there and then write off your your depreciation, your taxes, your insurance, your interest, so that, you have record of that, so that, if you do need to try to help offset some of that in the future, it's on there on your taxes. Because if it's not on your taxes, the whole payment is counted against you.
Yep. That's going to make it hard to qualify for anything else.
Could be. I guess everybody's situation's different, right? With their income and how much liabilities that they have and stuff. But yeah, I see that. That is probably, I hear that a lot. And sometimes it can affect the deal. They might not qualify for as much.
So how long have you been in cross country?
Cross country? Bill Riley and I opened up Cross Country Mortgage in the Dayton area, in September 3 years ago, so 2022.
Okay.
Yeah. I have been a mortgage loan originator since, I'm really dating myself right now. But I got into this business. My grandpa introduced me to this business, 1996.
Okay.
So I'm going on 30 years this coming year. Yeah, this coming year. And I think I started originating mortgages in 1998. So I actually started off with doing some behind the scenes clerical work, stuff at a small mortgage brokerage in Fairborn. And then, the rest is history. So we decided with Cross Country Mortgage, why I went to Cross Country Mortgage is the variety of loan programs that they had available. We saw the market was shifting, and we knew that based off of the way that rates were starting to kind of creep up a little bit, we needed to have every available loan program available to mankind, you know what I mean, available for our clients. And after doing all of our due diligence and interviewing, that's where we ended up landing. So we brought Cross Country Mortgage to the Dayton area. There was nobody here in Dayton with Cross Country Mortgage until we came. Now we are in almost every other state, almost at this point in time. We are headquartered in Cleveland. So our headquarters is in Cleveland. And we actually are the #1 retail mortgage lender in the United States. I mean, people are like, what? I've never heard of that. We are. We are the biggest and best in the United States. So I would just encourage, like, if you're listening to this, if you need a good, solid mortgage referral source, I would love, of course, to help you. But we have some great loan officers, that work, with me here in the Dayton Springfield area. Give us a try.
How high up in the company are you?
Oh, not. I just run the local branch here.
Okay.
Yeah, Bill and I do. Bill's out of Springfield, and we co-manage the branch. So yeah, I'm in charge of my loan officers that immediately report to us. Try to keep them happy, help them, and then of course I am an originating branch manager, which means I still originate. That's the majority of what I do is I still originate and do mortgages all day long. So I kind of wear a bunch of different hats. Lots of moving parts, lots, going on any given day. So I've gotten really, really good at multitasking. Let's just say that.
I believe it. How many agents do you have working under you right now?
Loan officers, I would say we have about 10 loan officers total. Those loan officers range from anywhere from Springfield up to Troy, Springboro, Dayton. We have one in Wilmington. I mean, we're kind of like all over the area.
That's cool.
Yeah. And I mean, we have some of our loan officers that, work from home, some. And then we have an office here in Beaver Creek and then one brick and mortar in Springfield. So, but yeah. I love where I'm at. I love the people that I work with. We have great operations support staff, great processors, loan assistants. I mean, it honestly really does truly take a team to get us to the finish line. I could not do this job without the people, that are clocking in every day and, doing all the behind the scenes work stuff, because it's a lot. I don't think people realize everything that goes into writing a mortgage. I mean, you guys, I think everybody would be shocked if they would one day in the life of what it's like being a mortgage loan originator. So.
Very cool. Well, give us a quick overview. What happens if somebody comes to you today and says, hey, I want to buy this house? What do we do? What are all these steps?
Okay. I had a conversation with somebody today. They had called me and they're thinking about purchasing a property. I said, that's awesome. I was like, the first step would be for us to do a soft credit pull and get some basic information from you. And in order to do that, I'm going to send you a quick link for you to jump online and fill out some basic information for me so I can take a peek at everything for you. So shot over my website, www.applywithlindsey.com, and that's an E, Lindsey.com. Shot a text message over, and they reply back, thanks, I'll get to that as soon as possible. And at that point in time, they'll just get on and complete the application. Once I receive that, I get a notification. Myself or someone on my team will jump in and start reviewing the credit, looking at the income. It is very important in today's world that if you are an hourly employee, I'm strongly going to encourage you, if you are in the process of getting pre-approved right now, make sure you're uploading your pay stubs for the lender to review. A lot of times if you're salary, it's not that big of a deal, but if you're an hourly employee, and especially in the world that we're living in right now of variable income, we have to make sure that your variable income is looked at and we're using the right amount of income. Because what happens a lot of times is I'll have a client fill out an application and they automatically state that they work 40 hours a week. And then I'll look at the pay stubs, and one pay stub shows 36, one pay stub shows 38, one pay stub shows 34. Well, guess what? That is not 40 hours a week. And I think what happens is they're scheduled to work 40 hours a week. But if their employer says, do you want to take off early today? They take off early today. And if they don't need to stay, when they're filling out the application, they just automatically put 40 hours a week. Well, if I qualify somebody and use 40 hours a week and then wait and look at their pay stubs later, and then all of a sudden they're only averaging, let's say, 36 hours a week based upon their year-to-date income because they just left early, because they could.
Yeah.
They might no longer qualify for what I pre-approved them for. So it's very important, if you're an hourly employee, to upload your pay stubs and let the mortgage lender do their due diligence, review the pay stubs, your year-to-date earnings, and look at your earnings for the past 2 years. That is actually huge, because you don't want to get yourself into a situation where, somebody just uses 40 hours a week for income and then it's not 40 hours a week. So needless to say, back to what I was saying, fill out the application, and then I would review that and then call them back and say, hey, I've reviewed everything. These are your options. These are the different loan programs that are available. This is, what the payments would look like, based upon this information. And then we just kind of start open conversation and dialogue on what they're looking for. And then after that, once we decide, yeah, that's what I want to do, then I usually shoot over the pre-approval letter to them and with their permission, to the real estate agent, that they're working with, just so that they have that on record, so they know what they're looking at, and kind of give them details on what they can afford, the different loan programs that they're going for, if they need seller paid closing costs. I try to be pretty thorough so that there's no questions or surprises later.
Nice.
I even try to put in there, if they're going conventional, and I know that they're putting 5% or 3% down, I even try to put in there, remember, max seller paid closing cost is 3%. Because sometimes, would you remember that? Sometimes it's just easy to forget. You know what I mean?
Sometimes it's easy to forget. And like you said, different loan programs have a different amount that they can put down.
Exactly. FHA allows 6% across the board. So, if you get them confused and then all of a sudden you've asked for 6% closing costs on a conventional 3% down, you've asked for too much. So, yeah, I try to be thorough as much as I can. But then send out the pre-approval letter, and then once they start looking, the lines of communication is always open if they need me to run payments, and then once they get into contract, the contract's sent to me, and then we dig in and we go.
That is a lot.
Yes, that's a lot. But all the behind the scenes stuff, when you run into little obstacles and stuff like that are that you don't foresee, what I mean? That's what can consume the day.
What's an example of one of those obstacles?
Oh gosh. Well, I'm not even going to talk about the one I've had today.
Someone decides to buy a car, or
that has happened. Yeah, or somebody has quit their job and didn't think it was a big deal.
I heard about that. There was one that didn't happen to me, but it happened to one of my friends. Somebody quit their job 2 days before closing.
Yeah.
They were like, why is that a big deal?
Yeah. Well, most of the time, I say most of the time, but most of the time when somebody quits their job, they have something else lined up, right? But listen, when you got pre-approved to purchase the house, it was contingent on that income, right, that you provided to that loan officer. So what if you were a salaried employee or an hourly employee, and then all of a sudden you took another job and now you're not salary or hourly anymore, now you're a 1099. That's a problem. That's a big deal. I mean, so you just have to be super careful. If you're going to change jobs, you definitely need to communicate. I'm talking to everybody out there. You definitely need to communicate to your loan officer or your real estate agent to let them know so that, they're aware of it, especially 2 days before closing. I mean, then we're scrambling.
Yeah.
Then we're having to get verifications of employment. If they haven't started the job yet, you know what I mean? You normally need a pay stub. So then at that point in time, we have to see if we're able to get a post-closing pay stub, you know what I mean, after closing. So it will definitely delay your closing if you do something like that and don't let the loan officer, know that you've changed jobs. Yeah. And don't ever take out new debt. You can use the debt that you currently have. Like if you have a credit card and you need to use your credit card, okay. But don't go out and decide you want a new car or student loans. I mean, I know people need, to take out student loans, but I mean, stuff like that. I mean, you've got to make sure that when you decide you want to buy a home, you're not opening up any new debt, right? No new credit cards, no cars, no student loans. Do not co-sign for anyone. If you co-sign for somebody, that means you're taking on responsibility for that debt. You will have to qualify for it. Sometimes people say, well, I thought I was just a co-signer. Well, that means you're responsible, So don't co-sign unless, you talk to a loan officer, ahead of time to see if that would affect basically you being able to purchase.
I've definitely heard about that. People are excited about moving into a new house. They go to the furniture store and they take out a line of credit at the furniture store and buy a whole bunch of furniture before closing, and then that affects everything. Oh,
yeah. Furniture. Yeah. In Christmas time, oh my gosh. Don't open up a credit card when you're buying a house or on Christmas time to save 10%. That happens a lot. Yep. They want to save the 10% because they're Christmas shopping and it will save them a good amount of money. I get it. But you're going to need to either wait or if not, it could delay closing because we actually monitor their debt up until the day of closing. So we will be notified 100%. If they open up a new debt, we're going to get a notification that states, so-and-so just opened up a new debt. And when I see those emails come through, my heart sinks every single time. Because, you don't know if it's, enough that's going to affect the loan approval. And sometimes it's not a big deal. It's just, I just opened up a credit card, but I don't have a balance on it. Well, then, we just have to have a letter stating, I don't have a balance on this, but I've had some that have been doozies, like $1,000 car payments that we had no idea about. So.
Can paying off debts delay stuff too? Like if you decide to just pay off all your student loans a day or two before closing, does that mess something up or no?
I don't think so, no. I will tell you, and I am not a credit expert, but I just know from personal experience, and it stinks because I think it's terrible that the way that the credit bureaus are set up is like if you pay off installment debt, because installment debt, like a car loan, I feel like is typically one of the longest accounts that you have open paying on, right? Because like if you take out a car loan, sometimes people take it out for 5 to 7 years. I had a car loan and the day after I paid it off, my credit score went down 60 points from paying off.
They looked at it as like closing a line of credit?
Yeah, because I closed an installment loan, my oldest trade line, you know what I mean? Or my oldest trade line on an installment loan. My score like tanked and I'm like, what the heck? You know what I mean? I wasn't late, you know what I mean? Just because I paid off my car, it's almost like.
That's just stupid. You're getting punished for doing the right thing.
Yeah, you're being penalized because you paid off your vehicle. So I guess, I don't know if that's any advice for anybody, but if you're looking to purchase a home, if you're planning on like paying off a car loan early, maybe don't pay it off early, you know what I mean? Because it could tank your credit. I don't want to say my credit tanked, but 60 points is a lot.
Yeah. Still getting punished for doing the right thing is kind of crappy.
Yeah. So I guess maybe maybe we should tell them not to pay off. We don't want their credit, you know what I mean, to go down, you know what I mean, because they're paying off installment, Dad. So I don't know. Like I said, I am not a credit counselor, but this is just my own personal life experiences that I feel like have happened to me. So
here was one last question, because it just popped into my mind. Every once in a while, I'll get someone asking me if it's okay for them to like get gifted down payment money or something from family or borrow it from family. How does that work?
Well, since you've asked, the gift process has actually gotten a lot easier on FHA in comparison to what it had been in years past. You definitely have to document a gift. So don't just have mom and dad throw $10,000 in your checking and savings account if you're purchasing in the next 60 days, okay? There's a gift letter that has to be filled out and signed by both mom and dad and yourself. And the gift letter basically will state, mom and dad are gifting you this amount of money. We do strongly encourage mom and dad to wire the gift money directly to the title company a day or two before closing. And the reason why we do that is it takes out the middle step, because if mom and dad wire the money directly to the child, then we're having to provide proof that the money went into the child's account and that mom and dad had the monies available to wire. So it adds a completely more steps than really is necessary. So as far as the gift is concerned, I would say there's a gift letter that has to be signed and dated, and then we would just encourage mom and dad to wire the money directly to the title company when we get closer to closing. That's the easiest way to do a gift. FHA did not used to allow for that. FHA used to make us have proof 30 days bank statements from mom and dad that they had the money, and people were ticked. People did not want to give us, and I don't blame them. You know what I mean? Why do you need my bank statement? I'm not, on this loan. But that was their rule, and they have definitely eased up on that, which makes it nice. So, tell your lender that you'll wire the gift to the title company. That makes it easier for everybody.
We've been going for a while. I appreciate you coming out. How do people find you?
How do people find me?
Yep.
Online, like I said, www.applywithlindsey.com, or I give my cell phone?
It's up to you. If you want people calling you.
Or anytime, my cell, 937-603-1711. But applywithlindsey.com, jump on there, check out the different loan programs that we have. And like I said, anybody at Cross Country Mortgage, if they work for us, they're good. So let me know if you have any questions. Thanks for having me.
Yeah, for sure. And you said Lindsey was spelled how on the website?
Lindsey, Lindsey with an E.
Perfect. Yes. Okay. Yeah, I can't hype you up enough. You helped me with my first investment property. Like I said, I tried so many others that couldn't do it. You just came through and made it look easy.
Good. We're happy. Awesome. Thank you.
Thank you again for coming out.
All right.